Good day, everybody, and thank you for joining us today for our Alternative Investments webinar. Today we'll be covering our review of 2023 and a look forward into 2024. Today joining me on the panel will be Conway Williams, our Head of Credit Portfolio Management and our Alternative Investment team, Michelle Green, Credit Portfolio Analyst, and Luzuko Nomjana, who's a Portfolio Manager in the Alternative Investment team. Today we'll have a review and unpack what alternative investments is, and obviously consider the return series that one can achieve out of these portfolios going forward. Alternative investments are an important part or a very important asset class in today's makeup of alternative investments that one can choose through a broad portfolio. So to cover this broad range of investments, I've asked Conway, maybe you can give us an update on alternative investment market and the themes that we've seen been playing out over the last year, and of course what to expect for the year ahead.
Cool, thanks. And good morning, everyone. So I think if you just take one step back and just start with what alternative investments are. As we've been presenting for the last 3 years, there's been more and more questions on what's the definition of alternative investments, specifically with specific reference to infrastructure assets. Why do you include it in your portfolios, and why should people include it in their portfolios? So the starting point is that alternative investments are everything that sit outside of your traditional asset classes, such as cash, bonds, and equities. So it's anything like such as private equity, private debt, project finance, even stuff like cryptocurrency investments. Those are the alternative investment universe. For us particularly, when we look at alternative investments, it relates to infrastructure assets, clean and renewable energy assets, assets that are more aligned to SDGs, that's the Sustainable Development Goals, or has to have that CISA infrastructure taxonomy or that definition, which is physical, tangible type assets that are actually used for public enjoyment. So when we build our portfolios, we need to make sure that it has an SDG angle. So, for example, renewable energy talks to clean or great workforces and the likes, and it meets those infrastructure definitions. And then I think the second part is why we've done this. What we've seen is that the rise in popularity of alternative assets is because, firstly, we have developmental needs within South Africa and Africa, and these sort of portfolios play a massive role in meeting those needs. Secondly, it's a great diversifier, as you alluded to. What we see is that these sort of assets have a proper decorrelation when it's not correlated with your traditional asset classes. So again, what that means is when your stocks and bonds do specific things, these ones offer an alternative to that from either a risk or return perspective. And what we've seen is that this has been a constant type return profile that you've received, and it doesn't have those shocks. And evidence of that has come through, for example, during the peak of COVID, where our assets in our portfolios actually withstood that volatility that COVID did bring. So again, it's very important for us as a house to invest in this because we want to actually earn commercial returns, which is another important part that this does bring. It brings a stability to various portfolios, whether it's used as a building block internally or we invest for a client. And then finally, for those developmental narratives. And that is why we actually push it, and we've built our business. When Luzuko and I joined, we had one fund. We have 3 funds now that look at these alternative type assets. We've grown it from about 1 billion to about 8 billion in total, and invested across whether it is the 2830 projects that are in our clean fund, our 11 projects that are in our infra fund, or in our high yield credit fund. We've seen positive benefits, positive returns, and really strong interest in these portfolios for the various reasons that I've provided.
Thanks, Conway. So important couple of points there is around the diversification. There's a need for these assets in an economy, in a country, from a developmental perspective. That decorrelation from a portfolio. Obviously, there's another component that's linked to this, which we'll talk about a little bit later, which is whether they're listed or unlisted. And obviously, the importance around being unlisted is that you need to look at them probably from a different angle from the traditional way you'd look at a listed investment, and maybe therefore more scrutiny, so deeper focus. And I think that's why we talk about having a team focused on alternative investments, because you need to look at it at a different angle. It's not necessarily a listed equity, it might be a listed debt instrument, and there's a different set of metrics that one would, go and analyze and interrogate for inclusion in a portfolio. And maybe at that juncture, just to talk about the inclusion, from a portfolio perspective, we find two markets for these assets. One is an institutional client portfolio that specifically want to allocate to alternative investments, and secondly, for use in unit trust funds. So we are typically, our more retail-oriented investors would get exposure. So again, the beauty is that because of the CISA regulations, which we know, you're able to include an element into a portfolio, and that covers that diversification angle that we spoke about. But turning to Michelle, we recently, Prescient launched the sustainability report, and I think this is a very critical angle as well, because obviously from a judicial perspective, the world is looking to ensure that there is sustainability in environments, and corporates have a particular level of governance and a sustainability approach to ensure that they're doing the appropriate thing. So the report covers a lot of this. Can we turn to you to maybe share a lot of the detail that was included in this report?
Sure, thank you, and good morning to the audience or listeners. So just to start off, I mean, what the report ultimately is trying to achieve is provide insights into what responsible investing is and sustainability effectively, and how we ultimately embed that within our investment decision-making process. So looking at unpacking those critical concepts of responsible investing, ultimately looking at our process and how ESG is embedded in our investment decision making, and then ultimately also showcasing that by speaking about some of our projects that we've invested in 2023. And if I can just highlight very quickly on two of them, one being Eagle Towers, and ultimately their purpose is to put up towers to bring about connectivity to rural areas, and that's off the backbone of knowing that 32% of our population in South Africa is actually within the rural areas and ultimately do not have access to quality connectivity, etc. So they bring about that quality towers in order to bring about or drive rather the economic growth and ultimately bring it to the rural areas. We've also partnered up with Jade Sky. Ultimately, it's a emerging Black-owned company. And there we've basically invested in 3 wind projects. And so again, we are growing our portfolio, and we're trying to showcase how ultimately ESG, we can use ESG as a risk assessment tool, but also achieve positive impact, but also the risk, being rewarded for the risk that we do take on. Now, having said that, we've always been critical of, or rather skeptical of, how ESG has been positioned in the market. So a lot of it, what we've seen come out is that ESG has often been equated to doing good. And so what we then wanted to achieve is actually to break down that narrative by building our own internal methodology. So ultimately, we pride ourselves on being the leading systematic house. And so what we've tried to achieve is to use our ESG methodology to use it as a risk assessment tool, which ultimately gives us a level of probability of default of where these companies ultimately lie on the risk spectrum. Now, being able to do that, and coming back to your point about good governance, etc., that portal, or rather risk assessment, allows us to pinpoint where the risks lie, but also how to mitigate, or which areas to mitigate, and opportunities as well. And what this report ultimately showcases is that over time, with a lower probability of default, it can lead to positive performance, and ultimately it does actually give us a level of how to value a company. So obviously, natural 101 fundamental on finance is higher risk, higher requirement of return. And so what we're trying to achieve, and simply put, is to quantify data that is largely quality or qualitative risks. And so what we're able to do is to monitor more effectively trends, have robust conversations with management teams, and moving the focal point away from what was said and ultimately focusing on the results. Because it is data-driven, we are able to have more effective conversations with these management teams and focus on what does the data show us, year-on-year trends. How can we then have more effective conversations to bring about impact in a positive way, but also how to value effective for the risk. So key takeaway is ultimately, we don't use ESG to save the world, but we use it as a risk assessment tool, and ultimately to drive how we can, off the back of risk assessment, value a company appropriately, but on the backbone of that, it does lead to positive correlation in terms of long-term sustainability, better cash flows or predictability thereof, and a lot of evidence has been able to back this. So the report is packed with a lot of data, but also what we can expect going forward.
Thanks, Michelle. So from a fund perspective, maybe Luzuko and Michelle, you can also jump in here as well. We run two products that you mentioned at the introduction. So let's start with the clean energy fund. So I think clean energy is important. You spoke about assessment. There's an environmental and a social impact. But I mean, I think if we just talk energy in this country, it's a huge topic. Let's hear about some of the great investments that you've got in the portfolio, which is helping us with this energy crisis we've got.
Great, thank you, and good morning to the listeners. So I think from the Clean Energy Fund point of view, it's a debt fund that's currently sized at about 3.8 billion, and it's invested across, I think, 28 projects at the moment, which are located across the length and breadth of the country. I think the fund has participated across all bid windows thus far, and we look to continue to participate in the upcoming bid windows as well. Just in terms of performance, the benchmark of the fund is CPI plus 4.5% on a gross basis, and the fund has consistently outperformed that benchmark and continues to do that going forward. I don't see any reason why it shouldn't be doing that in the near, in the short to medium term. But I think taking it back, the conversation back into some of the key trends you've highlighted quite importantly in my view, that as a country we continue to live through rolling blackouts, which we call load shedding. And by the assessment of Eskom and the IRP, NESA included, it seems that will continue being the case up until at least 2027. Therefore, this means that we'll continue having a shortfall of energy and generation in the country. There has been a few developments in the renewable energy asset class or sector space in South Africa. And I think one of the key ones really talks to, I think, strong continuing momentum in terms of renewable energy. And this finds expression in the fact that there's been recent continuous and consistent release of bid windows. We saw towards the end of last year allocation of bid window 6, where I think 1,000 megawatts of solar PV was allocated. There was 3,200 megawatts which had been bid, which had been invited to actually bid. It was unfortunately it couldn't be allocated due to grid constraints, which I'll touch on shortly. So that was bid window 6. There's been bid window 7, which was released I think 14 December 2023. Bid window 7 seeks to procure about 5,000 megawatts of renewable energy, 3,200 of wind, and about 1,800 of solar PV. I think quite importantly, and this talks to, I think, a greater need for energy in the country. We saw the first bid window of gas to power. So about 3,000 of gas to power that's expected to come online in the next few years. 2,000 expected to be procured from independent power producers. 1,000 megawatts is expected to be generated and developed by Eskom. There's also been, I think, a second bid window from battery energy storage, about 615 megawatts of that. And gas and battery, obviously quite important within the development of renewable energy because, of course, renewable energy is naturally intermittent in nature. You need some baseload capacity. You need a bit of storage, for your peak times, during the evening. And gas to power and battery energy storage seeks to try and achieve and close that gap. This also talks to, of course, the ongoing conversation of closure of some of the old coal-fired power stations that are owned by Eskom that need to be closed as time goes by. It has come, I think there's a lot of evidence that suggests that, trying to keep some of those power stations and keep them running for longer than they were actually designed to seems to be actually a lot more expensive than, generating more, new renewable energy. So I think that's one theme within the renewable energy space. Closely tied to that is then the conversation around grid capacity. think historically, when our grid, our national grid was developed, it wasn't developed with renewable energy, dispersed renewable energy in mind. And the RIP, which is our procurement, public procurement sort of platform for renewable energy, the success from that has really led to, I think, complete utilization of transmission grid in the Northern Cape, in the Eastern Cape, and in the Western Cape. Now, the question, therefore, naturally is, I talk about bid window 6, I talk about bid window 7, possibly bid window 8, which is again expected to be released in March 2024. Again, another 5,000 megawatts expected to come out of that. Where is this, how is this, all this new energy, how is it going to be, evacuated to where it is needed? And that's a necessary question. That's a very difficult question that the powers that be are actually grappling with at the moment. Currently, Eskom is setting up a work stream through which about 14,000 kilometers of new grid, national transmission grid, is actually going to be procured, and the indication is that it's going to be procured similar style to the RIP, which is actually quite, I think that's quite encouraging, because we've seen the success of RIP, and a lot of success is as a result of how it was procured, how it is structured, and the involvement of the private sector. So that is quite encouraging, but that's going to take time. That's going to require a lot of investment in terms of cash. We're not going to have 14,000 kilometers within the next sort of 2 to 3 years, for example. So as a short-term measure, what Eskom and NESA and the IRP have done is to apply what is globally known as curtailment, which really seeks to say, you curtail up to 10% of the power of the generation from existing, generation plants, renewable energy generation plants, and that I think the capacity assessment report has been released recently, and that has basically indicated that there's about 3,500 megawatts of additional capacity that has been freed as a result of that. 2,700 of that is going to be in the Western Cape. About 790 megawatts of that is going to be in the Eastern Cape. Of course, it doesn't really solve the 3,200 of additional wind capacity that needs to be allocated. But I think one then needs to take a step back and say, sure, there isn't available capacity above this 3,800 megawatts in the Eastern Cape and the Western Cape. But is there any other available grid in the country? Certainly there is. I think by Eskom's calculations, there's about 19,900 megawatts of available grid capacity across the country. Of course, it's not in the Western Cape and the Northern Cape, in the Eastern Cape, where there is absolute abundance of renewable energy sources, but across the country, the rest of the country, there is still capacity. And I think when one needs to look at it from the point of view that, of course, it is not, these resources in in the rest of the country is not as strong as it is across these 3 provinces, but I think comparatively it is much stronger than anywhere else in the world. So there's still that capacity across those areas. And maybe to close it, and I'm taking up a lot of time, maybe I think a final theme is we've got all of this energy coming online, procuring 5,000 and about 4,000 between gas and petrol energy storage. Where is local manufacturing capacity? And I think that is a very good question, because it's one of the key tenets, one of the anchors in terms of just energy transition. We said back in the day that developers of renewable energy components do not want to set home or set house in South Africa because there isn't consistent sort of release of bid windows. Now that has been the case over the past 2.5 years, so to speak. And if one looks at the IRP 2023, which is currently out for comment, that seems to be continued. There's a clear intention to actually continue that. So it seems the demand, the consistent release of bid windows has been resolved. I think what is still lacking, though, is policy support. From the point of view of trying to support local manufacturing. And to give you an example on that point, I think by Eskom's calculation, about 6,000 megawatts of solar PV, rooftop solar PV, actually came online I think over the past year and a half. This is 6,000 megawatts. This is a lot of solar panels. And unfortunately, all of these solar panels pretty much, or maybe significant majority of that, were actually imported from China and from other countries. Of course, they come in at much cheaper prices compared to what would be procured and what would be produced locally. So we need ability to actually protect our own production, our own localization, to really take advantage of this booming renewable energy. So I think those are the key three themes for us that are coming through within the renewable energy sector. I think a lot of opportunities going forward, but of course there are still a few issues that are quite fundamental that I think we need to resolve and focus on as a country.
Thanks, Luzuko. Conway, maybe turning to you just to comment on the IRP, and maybe the question I'm actually angling at is probably it's trying to address the shortfalls we've got in energy mix to by 2030, I think the initial plan is. But do you see enough opportunities coming on and investable opportunities for the needs in terms of names in the portfolio that you'd be prepared to look at?
So I think if you just listen to what Luzuko said, there are numerous opportunities, and all of those fit within the mandate of the fund, whether it is battery storage, whether it is assisting with grid transmission and the likes, or just the traditional PV wind type opportunity. So we're quite excited about. Our pipeline is quite extensive across the two funds and even our third fund, where we can make that developmental sort of impact while earning the commercial return. So we're very excited about it. But then just to go back to the IRP, and it's something that's very important to us because that is the backbone of our electricity supply and the likes. The last one was issued in 2019 with a 10-year plan to 2030. And the reason for the launch of the IRP 2023 on the 4th of Jan is that there's been significant changes in the local industry or the local ecosystem since 2019. So there had to be a relook at actual assumptions, inputs and the likes. And I think one of our key thoughts on it is that we believe that the rollout of renewable energy without that grid expansion that Luzuko touched on means that one of the key assumptions on decarbonizing at the pace that we wanted to is very questionable. And that's why they had to release the new IRP. So that is one of the key positives of it. But again, what we believe that there are a little bit of shortfalls within the IRP is, for example, the transmission system that Luzuko mentioned. Without that, we can't have renewable energy. We can't meet our COP commitments or just our commitments to get to that just energy transition. So importantly, nuclear and coal still remains one of the contributors to our plan. And again, we need that because of that stability that it brings and the likes. We do also think that, for example, if the IRP contained more information on transmission and grid expansion, it would have supported a push for that. And then it would also attracted investment. So the IRP changes, I think it's a bit of a mixed bag in terms of positives and negatives, but I think the important part is that it's out for public comment right now. So we're taking it very seriously in terms of what sort of commentary that we can provide on improving the IRP, as an example, before it's going to be gazetted, and then see how we can then channel funding from our investors into the project so that we have sustainable electricity. The IRP mentions that we will have rolling blackouts till 2027 because of the various issues that were raised. But I think the important part is that the assumptions, the questioning, the public comments that should actually happen will happen, and then we can have a very robust plan to make sure that post-2027 we don't have those rolling blackouts anymore. We have a demand system that is equating to the supply, and that we can then foster that sort of industrialization, manufacturing, economic growth and the likes. Because infrastructure is the backbone of this country if we want to improve the lives of the man on the street. So importantly, we need to take it very, very seriously.
Thanks, Conway. So we've spoken about, mentioned the one fund, the other fund is the infrastructure debt fund. Michelle, do you want to cover a little bit on that for us?
Thank you. I think the best way to do so is just to showcase the portal and take you through exactly what the fund has achieved over the last couple of months. So just to take a step back in terms of what the investment universe of this fund ultimately entails. So it allows or provides investors with investment into infrastructure development projects, which ultimately is showcased here. So it's across various sectors, that being housing, agri, for example, even tourism, water infrastructure, and ultimately this is quite closely tied to helping achieve the National Development Plan, which we've already touched on, and ultimately provide investors with types of projects or investments that ultimately wouldn't be accessible to just the man on the street, and ultimately provides a well-diversified portfolios across these sectors. Now, in terms of the overview of the fund, having been launched in October 2021, this fund has significantly grown over time, achieving a size of 1.6 billion as at the end of December. Its targeted benchmark is JIBAR plus 3% and has been able to achieve a current yield of 12.4%. And that is, across a weighted average term to maturity of 4.4 years, speaking to its underlying assets. So ultimately, speaking to the purpose of the fund is to invest in infrastructure, but also achieve that socioeconomic impact across South Africa. And we like to think of this fund as a social responsible investing vehicle, ultimately to provide investors with a range of opportunities, but also being able to outperform its benchmark. Now, speaking about performance, these two charts ultimately showcase that the fund has been able to outperform its benchmark since inception, being able to achieve that diversity, but also to contribute to at least one of the SDGs, being social development goals, and to improve the socioeconomic growth across the country.
Thanks, Michelle. Really good performance out of the portfolios. And I think there's certainly a high demand from investor requirement for this sort of asset class. Particularly we see that in the institutional space, and obviously from a retail perspective, the diversification angle that we see in the unitized portfolios. But obviously that then brings up this question around pipeline. Luzuko, do you see enough coming on stream? And let's talk about the risk-reward characteristics of these assets, and maybe just the pricing effect and how you look at what's coming on stream.
Yeah, sure. From a pipeline point of view, I think we continue our efforts, continue to show returns from a development of pipeline point of view. The Clean Energy Fund, for example, has a pipeline of about 3.3 billion as of today. And that excludes bid window 7, bid window 8, the gas to power, the battery energy storage, bid window 2. So really strong pipeline, and we continue obviously our efforts. We continue staying close to the banks, staying close to the developers, previous and existing borrowers to develop that pipeline. From the infrastructure debt fund, broad infrastructure debt fund point of view, pipeline there is about 1.6 billion, and that's really diversified across various sectors, which obviously we define as infrastructure. And that is one of the key reasons we're looking to achieve maybe a target of about 2 billion by June this year in terms of the infrastructure debt fund. But time will tell. You asked a question around the pricing. I think weighted average pricing on the infrastructure debt fund, just in terms of the pipeline of the opportunities that we're looking at, firmly above 3 months JIBAR plus 400 pips, and that is really one of the key reasons we're comfortable to continue saying that the fund, performance of the fund is going to continue outperforming the benchmark. And that's really driven by the opportunities we're looking at. Similarly, in the clean energy space, of course, there's a bit of tightness in spread around senior debt participation, and that is obviously a product of a maturing asset class. That's a product of a lot of demand coming through from a senior debt point of view to try and participate in these assets. But nevertheless we continue to see opportunities. We develop specific niche markets where we believe that they will give us competitive advantage, and again our pipeline gives us a pricing that's firmly above the benchmark of CPI plus 4.5 pips, and that is why again we're comfortable to continue outperforming the benchmark. So I think really strong momentum across supported by strong regulatory basis. Of course, load shedding does give a lot of drive a lot of demand and market opportunities for clean energy. But I think generally as a country as well, think we fortunately have come to realize that infrastructure is actually quite critical in developing this country and in turning around the economic opportunities for this country. So there's a lot of effort being put driven towards infrastructure, and now we continue to benefit from those opportunities.
Thanks, Luzuko. So importantly, in assessing a new deal that may be coming to the table, let's talk about the investment process. Michelle, as a credit analyst, run us through the investment process and particularly how you look at names in terms of the assessment for inclusion or not.
Thanks, Murray. So ultimately, our credit process, what it entails is looking both at financial and non-financial factors. So before we actually get to assess the opportunities, there needs to be an origination of sorts. So the team is responsible for origination and ultimately bring about these opportunities to the table. And once we have the set opportunity, it goes via our initial deal forum, assessing basically a level of risk and ultimately the opportunity set. So what that means is looking at the due diligence from a financial, so looking at the performance, looking at the cash flow metrics, looking at the balance sheet, how strong the balance sheet is ultimately, and that all gets run through our portal. And so again, coming back to the data-driven process. So ultimately looking at both the financials but also non-financial, which is the ESG assessment, and then ultimately that gives us the probability of default, where we are able to assess the risk assessment and then price or value this counterpart to make sure that we are being fairly compensated for whatever level of risk. So this gets discussed at our initial deal forum. Once it gets the go-ahead, we ultimately then do a full due diligence over and above a bigger report basically, and that then gets put together and presented to our investment committee. So once our investment committee ultimately gives the go-ahead, that then goes further from a legal negotiation point of view before it actually gets into the fund. Now, most importantly, as part of that due diligence, we need to assess whether or not these opportunities actually meets the mandate. Is it actually suitable for the nature of these funds that we're going to be investing in, and ultimately work with those parameters. So once we're able to get the go-ahead from our investment committee, which is independently chaired, we then go through a process and ultimately through an allocation process, it gets allocated to the suitable funds thereon. So that ultimately is our process in a nutshell.
Thanks, Michelle. Conway, it's quite a lot to consider in terms of pipeline, sourcing deals, et cetera, et cetera. So I assume quite an experienced team. Maybe you just want to talk about the team structure and a little bit, how you go about putting this all together.
So I think from an origination perspective, as Michelle said, that's the start of what we do and how we do it. So we would either get deals presented to us from banks or from intermediaries, or we have our own networks that we source our opportunities. That does take a lot of time. It takes a lot of coffees, so we come to work very caffeinated at times. But again, you need to build those networks. You need to show that you are able to execute an opportunity so people bring you follow-up deals. And that is why, as Luzuko mentioned, we've got a 1.6 billion rand infrastructure pipeline and close to a 4 billion rand clean energy pipeline through our initiatives. That does take a lot of work. But again, the one point that Michelle had mentioned is the team does a lot of work to actually assess those opportunities and then also to monitor the opportunities once it's on book. So you need an experienced team that knows what they're doing. But also you need to be supported by a system that helps you assess that credit rating or the default probability. So in our first year of joining PIM, we took a lot of time to refine our process, to understand which metrics are important for which sector, so that we don't have to reinvent the wheel every single time we do a new deal. So again, we get the financials, we get the forecasted models, we get the various reports, we upload it into our system. We've got a system that we built that can assign various probabilities of default, and then it spits out. And that is a very efficient process. It helps us to screen more opportunities, to take it to our initial deal forum in a manner which is more efficient than we've done previously. So again, today we upload financials, tomorrow there's a default probability. We see, okay, it's JIBAR +3 or JIBAR +5. The risk return doesn't match up, or it actually matches up, and then we present it. See, so we don't waste time because we've spent that initial time and a lot of time building that. And again, that's also very important from a monitoring perspective. You upload the financials, the covenant reports, and the forecasts. You again see what the rating is. You see whether you should be having serious conversations with management, restructuring, and the like. So our process, because it's so data orientated, and because we built that system, again, that assists the team from a capacity perspective to not be sitting there and looking at all of the underlying nuances, because our system allows us to do it. Does that mean that the system does all our work? No. You need that human element. You need human judgment to assess whether the returns or the forecasts are actually making sense from what management provides, also to do sensitivity analysis and the likes. So in a nutshell, we've got the people to originate. We've got the people to monitor. We've got the system that we spent a lot of time building. We didn't buy an off-the-shelf type product, so that we can assess risk on a continuing basis. And yes, the funds are at the size now where we believe that we are appropriately capacitated. So it's the three of us supported by 2 quants and a grad. And again, as we see more flows, we've got budget to actually hire further individuals. Because again, you have to always keep your eye on the ball once an asset is in the portfolio. And that means monitoring takes as much of importance in our lives as getting a new deal. Sometimes the sexy or the exciting part is executing legal negotiations. But where you actually make money or lose money is when you take your eye off the ball or you keep your eye on the ball. So we're very happy with the team right now. We've been together for a long period of time. Michelle and I have been together, working together for about 12 years. Luzuko and I, and the three of us for about 8 years. So it's been a nice team. We know our strengths and weaknesses. For example, Luzuko is project finance, renewable expert. I know about agri and high yield credit and the likes. And then Michelle knows everything about credit. So again, when we have that initial team forum, sometimes it's very easy, it passes. Sometimes it's robust discussions where we go in at each other to find out what the risks are and the likes. But again, we believe that our process is robust. Over the 3 years and almost 5 billion of deployed assets, we've yet to see a restructure. Touch wood, remember this is credit. There are risks. It's not government bonds that you are buying. We haven't seen default. That potentially will come over time. But again, we think that with our qualitative and quantitative screening, qualitative and quantitative assessment, and then how we take our deals to our credit committee, that it is robust enough to withstand sort of questions and the likes. And we have the capacity.
Super. Thanks, Conway. Well, folks, we come to the end of our time together, but so maybe just in closing to say thanks to my colleagues for the insights. I mean, certainly this alternative investments is an exciting and interesting and detailed environment to dig into. And importantly, from a client perspective, we think that the aspects of what, the ESG, but more specifically the E and the S component contribute towards a portfolio outcome, not only from a return perspective, but the good that it's doing for the population and the infrastructure of our country to help grow South Africa. We know that this is an asset class of great interest because of the return profile and the points that we've made in this webinar today. So thanks for sharing. I mean, I think always we like to display our track record, our capability, and certainly the performance, which has been really good. I think our data insights and the risk overlay is always critical. And, we're excited about what the year brings. So the windows of opportunity, the changes that we expect to see, and certainly it's a strange macro environment we're working in, but decorrelation or negative correlation to typical equity and bond asset classes, we know where these sorts of assets play an important part in a client's portfolio, and certainly include them, as we've stated earlier, where appropriate to deliver the returns that we're looking for across our portfolios. So thanks to you guys, but before we leave, certainly there'll be an opportunity for questions. So if you wouldn't mind posting your questions now, and we'll answer those as soon as they come through. Thanks very much. Okay, thanks, guys. So we've come to the question time, and the first one that's come in, Luzuko, is around this wonderful pipeline of 5,000 megawatts of capacity coming. But how do we get this to the population? The capacity constraint, I think you mentioned 3,800 megawatts. What's the plan there? Because if you can't get the power to the people, it's great having the project.
Yeah, spot on. And I think that's a very good question, because it was a strong cause of concern for a lot of the developers, in fact, that you're releasing between the 5,000 megawatts that you're seeking to procure, yet there's only capacity, transmission capacity for about 3,800 megawatts. And I think that's a very relevant question in the context of what we're faced with regarding evacuation of this grid. So I think it's quite important to highlight here that sure, we've got additional 3,800 megawatts that has been freed as a result of the curtailment exercise, but that's only in the areas that actually have strong renewable energy resource, and that talks to the Eastern Cape, the Western Cape, and the Northern Cape. Elsewhere in the country, though, we still have about 19,900 megawatts of available transmission capacity. And this, I think, effectively then forces developers to actually look elsewhere outside of those three provinces. In fact, in the Free State, for example, there's a few existing renewable energy plants. In Limpopo, there's a few there, I think one or two in the Northwest as well. So those are areas where there is existing plants, there is existing sort of examples of renewable energy resource that is actually being transmitted to the grid as we speak. So there is opportunity there for developers to actually go into those areas.
Put them in different areas. It doesn't have to be in the
Absolutely.
major cities that you mentioned or provinces you mentioned. Go and put them in the outlying areas, which has benefit for those communities as well from a jobs creation perspective.
Use water. And that is exactly the whole idea. Of course, this does result, I think, the IPU officers admitted to this. This may result in a slight uptick in terms of the tariff, but I think that is sort of within what was considered, and I think it is acceptable given where we are as a country. So certainly, there is a bit of pressure in terms of those three areas, but I think there's opportunity to actually, look at other areas and allow other communities to actually try and benefit from this.
Okay, so I think just to add to it as well, with the release of the 2023 IRP, one of our recommendations, and again, it's a commentary period right now, is make sure transmission is firmly embedded within the IRP, because then you have to take it seriously.
You're linking them together.
Exactly, and which means then it has government backing and the likes, and it shows that you can evacuate the power in a specific manner. Because that is how the global context has evolved and how the renewables have been flourished.
Yeah, great. Thank you, Conway. Obviously, an important part of this is the analysis and specifically the credit analysis. So we've got a question around in the unlisted space, and maybe this is one for Michelle, specifically around what are the major risks that you're looking at when assessing, in the unlisted market, potentially new projects coming to the fore. So obviously, this is not a going concern necessarily. It's not listed where you can, everything's as transparent as you maybe would hope it to be. You've got to go and do some deep due diligence. What are the key factors you look at?
Yeah, so thanks so much for that question. I think just to take a step back, I mean, one of the three key critical, I guess, elements of credit that we do look at is, or rather 3 C's of credit is character. So who is actually managing the overall project, for example? Is there collateral, so security, for example? What sort of capital, where are we lying in terms of the capital stack? From a risk perspective, are you right at the bottom close to the equity holders, or are you actually sitting at the top where you have security? And then, of course, the capacity. So this speaks to, are they able to, or more the financials, speaking to, are they able to actually take on this additional funding that we're hoping to obviously invest in? So part of that is looking at the credit history, looking at the track record, again, speaking about our matrix, our risk matrix, and plugging all of that data from a financial perspective, but also, from a non-financial, which is the ESG bit. And so ultimately, the analysis that we're trying to, basically the question we're trying to answer is, will these counterparts be able to repay us back? And so, as part of that, we're looking at cash flows. So looking at revenue drivers, for example, the strength of the actual specific project, for example. So, and also looking at the probability of default. Now, having said that, you want to also take a forward view in order to answer those questions. And as part of the risk assessment, an unlisted deal, let's just maybe use a project finance type transaction. So here we want to understand what is the technology involved here, understanding the technology. If we don't have the expertise, we actually bring in an engineer, etc., to understand the project, or rather the technology, before we actually go and invest. So the important bit is for us to understand what we invest in, who the parties are, and actually what sort of risk sits with that. So whether it's understanding the technology, whether it's understanding the construction risk, etc., but also looking at looking at it holistically. And so as part of the T's and C's, it ultimately helps with risk mitigation, and ultimately what we build that in is as part of the structuring of the transaction, so that the covenants or reporting, for example, and so that helps mitigate the risk. Ultimately, you stay close to the level of detail, or covenants in this in aspect where you want to maybe restrict debt, further debt this counterparty can take on, or even ensuring that there's a level of liquidity in order to help cushion unforeseen events that may occur, such as we just came out of COVID, and liquidity was quite a big aspect of a lot of companies not being able to tap it. And so as part of the risk mitigation and part of our risk matrix, we want to ensure that we are fairly compensated for the level of risk, and that these are the type of questions that we want to answer before we can actually be comfortable to invest.
Okay, thank you. There's a question which I think is sort of links quite nicely with what you said, and we talk about liquidity and the marketability of investment. So the question goes along the lines of, if you've got an asset in the portfolio and you actually want to on-sell it, how easy is that to do? You might want to replace the asset for whatever reason. Are these assets easily saleable, if that's the right question?
Yeah. So when we look at the liquidity portion in terms of what the pricing should look like, we combine that liquidity consideration with our default probability to get an ultimate price or minimum required yield that we should earn on an instrument. For unlisted instruments, we actually assign a 365-day liquidity ability to sell it in 365 days. Whether we'll be able to or not in 1 week, 2 weeks, 6 weeks or not, we go for the most conservative approach. But we do make sure that we understand when we're structuring opportunity, what general standards are. For example, you have to have a shareholder of reference, that your instrument actually has audited financials for that borrower for the past X amount of years. So all of the things that other players might look at or might consider when they have it, we've got all of those minimum requirements as our requirements for purchasing an instrument. So that when we sell it, we can show that all of those things are there. We also structure our opportunities from a legal perspective that we can transfer it. Now the question is, when there's an actual issue or a major economic event or COVID, can you sell these instruments? The answer is probably no. And for that reason, you have to construct your entire portfolio with a blend of the yield-rich, very liquid instruments with the more HQLA or high-quality liquid assets. So for example, in Luzuko's Clean Energy Fund, we have a 20% liquidity buffer. In the infra fund, we also have that 20%. Funnily enough, in our high yield credit fund, which also takes unlisted alternative assets, we know that within 7 days, we can liquidate up to 60% of our portfolio to cater for redemptions, withdrawals, and all of those sort of issues. But when we partner with clients, we explain to them the nuances of alternatives, the nuances of unlisted credit. And importantly, if you want your money, yes, we'll move heaven and earth so that we can cater for yours, because life happens. But you have to understand, we're looking for partners who know that we're going to give you that deal. We're going to do whatever we can so that we can be the best funds in the country. But that does come with liquidity considerations.
And the obvious point here is that you want to hold those, if the asset's good enough, you want to hold it to maturity so that you actually get your value ultimately realized. Thank you. Maybe Luzuko, just we spoke about the potential deals coming on stream, and there was a question here around, will this what you're seeing, is it predominantly in the solar and wind space?
I think focusing on the REAP program, the focus there is on wind in terms of capacity. So I spoke about 5,000 megawatts, for example, for bid window 7, which was actually consistent with bid window 6 as well. Out of that 5,000, 3,200 megawatts is attributable to wind, and the remaining 1,800 is attributable to solar PV. And there's a specific reason for that, actually, because while solar obviously is dependent on the sun, in terms of production profile, as soon as the sun sets, it sort of stops, producing. Wind on the other hand, is actually has a better or a longer production profile, 18-24 hours sometimes in specific areas. So it's really the combination of those two that really works to really bring additional capacity onto the grid. But also, I think from a 24-hour production profile, that is why there's the specific focus on wind. This is actually reflected in the tariffs as well, that wind tends to fetch a slightly higher tariff, slightly higher returns for the investors that So I think that is really the focus.
Okay, great. And then last question, maybe before I have one of my own, is around, we're talking about the shortfall in the transition capacity is, there's a great work here that can be done between government and private. Is these public-private partnerships, do you see opportunity coming there where the two parties work together?
Yeah. I think certainly. I think we sort of generally all know Eskom's sort of financial profile, and the ability thereof to procure, to go out to the market and try and roll out these sort of big capex requirements. So there's absolutely it's no doubt in my mind that the private sector has to be an integral part of it. In fact, there's currently a work stream that is being set up specifically for this expansion of the transmission grid, in terms of which it's actually being set up to mimic or to mirror exactly the RIP procurement program, in terms of structure, in terms of how the players will be procured, in terms of who the developers will actually be procured and be invited to actually bid. And it will be a build, operate, transfer, slightly different from RIP on that front, that RIP is build, own, operate. Here, in terms of transmission grid, is going to be build, operate, and transfer after 10 or 15 years, depending on the location. So certainly, I think really the driving factor here, from a financing point of view, but also from a developer point of view, the private sector will certainly be really driving that and be involved, because the government is going to continue owning the transmission grid, especially after the transfer period. But also, I think really there's a focus here to say the government really should be driving the regulation and the law, but allow the market to actually drive the pricing and the financing part of it, and that is what is being reflected here. So certainly, private sector is going to be an integral part of that.
But I think expertise, yes, we can bring financing, we can bring learnings from a global perspective, we can bring. That is where the private sector can really play a role. I think Luzuko can talk for hours about storage as an example, how storage actually helps with transmission. And what we're trying to do is invest in the entire vertical, so that we're not only looking at the coal-based renewables, but actually the downstream portion, transmission, storage, and the likes. And then also that creates the normal job content. And then importantly, like I keep harping on about this IRP. The IRP is the blueprint for our entire nation's survival.
Sure.
And if you can embed the transmission in that, including how you're going to have incentives, how tax breaks and the likes are going to work, all of that can help for us to evacuate that power. So again, everything that we want to do, include storage, allows us for that transmission mechanism to actually work. And that is going to be the big comment that we're going to send through. Because I think the IRP is missing that.
Be more inclusive of all aspects of what's required.
And we can talk between Luzuko and I have been doing this for a while. The REAP program has been a resounding success. Yes, there's been periods of intermittent, what you would say, volatility. But the blueprint is there. So we don't need to go reinvent the wheel. So use that same for storage. Use that same, as Luzuko said, for transmission. And then we can actually have a full ecosystem that actually creates jobs, gives us that energy sustainability or security. And then we can move towards those cleaner initiatives, move away from the decarb quicker than we want. So I think that is where we're very supportive and very excited about it, to be honest.
Thanks, Conway. So I said, I've got one more question. So, it's more raising awareness, I guess. The sustainability report that you spoke to, Michelle, is an extensive document that we prepare. Just please remind us the importance of that, the content, and who should be reading it.
Yeah, thanks so much for that question. Ultimately, who benefits the most is our clients, but also prospective clients, and those that's interested in how Prescient looks at sustainability, but also how our process works from an ESG perspective. And I think what is really important is that we're trying to showcase our process and how we are able to do what is normally a natural bias kind of process, but how we actually do it in a systematic way. And so ultimately showcasing how we assess sustainability, but also ESG. What are the factors that we actually use or rather look at to assess certain companies, etc. And so what we're trying to showcase here is provide live examples of such, but also showcase how we're able to achieve what we do, and also the performance and the impact thereof. And so what the key takeaways, what we're trying to also achieve is is to showcase that we do not embed ESG or sustainable investing in a way that is from a tick box approach perspective, but rather we live by that. And it's as important as doing the financial analysis. We want to actually showcase that we can achieve what we do through our systematic process, but also get that positive impact, get the commercial returns for our clients, and we showcase that throughout the report. I think as guardians of managing clients' money, or rather their savings, we are responsible to actually ensure that we manage capital, we preserve that capital, but also we are compensated for that. And we showcase this by providing our clients with certainty. We promise that to our clients, but also what we're trying to showcase is not only that we look at the full value chain. Ultimately, what we're trying to achieve is long-term sustainability. And so as part of the risk management angle, just to put it into perspective, like I said, a systematic approach, how we're able to do this, we actually run about 120 million data points. We run. That just sink in. And so what we can showcase is that we have access to this information. It broadens our analysis, it strengthens our process, and it creates more efficiency for analysis ultimately. And so we showcase this, we showcase our returns, we showcase how we're able to have a positive impact, not only through our projects, directly and indirectly on communities, and we actually give live examples, like I mentioned earlier, in terms of where it sits in our clean energy fund, but also our infrastructure debt fund.
Super. Thanks very much. Folks, very conscious that we've consumed a lot of your time this morning. We do appreciate you joining. I'd like to say thank you to the team for the insights, the conversation. I think a great display of what's going on in this space, particularly from an opportunity set, assets coming to market for inclusion in portfolios over time. I think the strong risk metrics that are in place. I mean, obviously, as you've said, this is clients' capital, custodians. We have a fiduciary responsibility to do a very detailed analysis, considering everything with the significant amount of data input that we'd consider. And folks, we really encourage you to review the document that Michelle's spoken to. Please visit our website to review the funds that we've spoken about today and that the team manages. And of course, we're always keen to engage further. So thank you for your time, and we look forward to engaging you in the not too distant future.